What's up, guys? Welcome back to my channel, Mortgages with Mike D. If you're new to the channel, I am a licensed mortgage advisor. My goal and my mission is to help educate consumers and whoever's watching when it comes to the mortgage process and just better understanding the ins and outs. There's a lot of moving pieces when you're buying a house, refinancing, so I hope to provide value and relieve any stress that comes along with the mortgage process. So without any further ado, let's dive into today's video. We are going to be talking about the infamous debt to income ratio, also known as DTI, and it's honestly one of the biggest components in the mortgage process in terms of when lenders are assessing whether or not you are qualified or eligible for any specific loan program. And it's important that you really understand DTI prior to beginning this process. A common question that you always hear from a consumer is, how much can I afford? Or I'm not sure, how much can I afford? And worst of all, you'll have clients that will reach out to a real estate agent and they'll start looking at houses without really a goal in mind. It's problematic because, especially in today's market, speed is so important. So if you're wasting time looking at houses in which you might not be able to afford from a lender's perspective, you're just wasting time, and you might be missing out on opportunities for houses that you can actually afford, but you're looking in a price bracket that's above where you actually are. So let's talk about debt to income ratio, what it is, how it's calculated, and why it's important. So the simplified definition of debt to income ratio, or DTI for short, is it's basically the percentage of a consumer's income that goes towards paying debt on a monthly basis. That's really it. So this helps give the lender a better idea and understanding of how much of a housing payment you can take on and ultimately afford. So they're basically just looking at what's coming in every month versus what's going out every month. So let's kind of break these up. We're actually going to get into a detailed example, so it'll give you a much better visual of how this actually works in real life and how you can actually put it to use. So let's start with the income. Looking at your gross monthly income, and again, it's monthly. So everything that's being measured is on a monthly basis. So let's just say you make $60,000 a year, divide that by 12. They're going to look at your income as $5,000 a month. Okay, pretty easy. Now your debts, let's look at that. So when a lender pulls your credit report, they're looking at any debts that are being reported on your credit. So typically things are going to be auto loans or leases, personal loans, credit card debt, student loans, so on and so forth. And what they're looking at are those minimum monthly payments. They're going to add all of them up, and they're going to use that sum as your total monthly current debt figure. Okay? It's important to know with your monthly debt figures, the lender's not going to take quite a few things into consideration, some of which you might think that they would. So, for example, they're not going to look at utilities. So they're not looking at water, electric, sewer, trash, anything like that. They're not looking at your cell phone bill, internet. They're not looking at even some bigger expenses like child and daycare expense in most cases. So it's important that you're well aware and familiar with all of your expenses, because although the lender might not be super concerned with that when they're evaluating what you can and can't afford, no one knows yourself better than you. So it's in terms of what you're going to feel comfortable with paying every month, make sure you actually know what's going out every month, because it's also going to be important to know your own comfort level and what you feel appropriate for that housing payment. And I think that's an important piece, okay? Because again, you have to feel comfortable with what you can afford. All right, guys, we're going to go to the whiteboard here. I find it, I know for me personally, for a lot of you guys out there, looking at an example visually gives you a much better sense of how to understand something and ultimately figure out how you can use what we're talking about, in this case, debt to income ratio in real life. So we already talked about what debt to income ratio is, how it's calculated, why it's arguably one of the most important components in determining whether or not you will be approved for a home loan, purchase, refinance, whatever the case may be. So without any further ado, let's get into an example. So very simple. We're going to start with your income. Let's assume that you're a W-2 employee. You just make a base salary. So your salary on an annual basis is $60,000 a year. Now remember, we talked about earlier, everything that's going to be analyzed is broken down on a monthly basis, okay? So $60,000 is also known as $5,000 a year, okay? Easy enough. So that's the income portion. Now, the debt portion. So we're going to use very basic, common debt items that a lot of consumers have, all right? Number one, an auto loan. So this can be a lease, it can be a loan. Let's just assume this is an auto loan, okay? And your monthly payment for that is $500, all right? Now, something else that's very common are student loans. Yours might be more, they might be less, all right? But let's just assume that your monthly payment there is $200 a month. And then finally, credit card debt. So let's assume you have, 3 credit cards, each of which that minimum payment is $25 a month, which would equate to $75 a month in minimum payments in credit cards. All right. So your current total monthly debt comes to $775 a month. Now, I think it's important to note this. When lenders are looking at your debt to income ratio or DTI, you might be thinking, well, I got utilities, I have childcare, daycare cost, and the list goes on and on. Although it's important for you to always keep those things in mind, the lender is not looking at that. They're generally just looking at what is being reported from the credit report that we pulled and reviewed, as well as any other debt that you might have disclosed, okay? So, again, your total current monthly debt right now, $775 a month. So, that begs the question, all right, well, what's my current debt-to-income ratio before we bring in a house into the mix? So, all we do is we take that total monthly debt of $775 and we divide it by $5,000, which is your monthly income. And that comes to 0.155. Times that by 100, that's going to come to 15.5%. All right. Now, it looks pretty good. But again, we haven't factored in the largest component of this, which is likely going to be your new housing payment. So let's solve for that. So this is the most important part here. So it's easy to really kind of calculate what your debt to income ratio is, assuming you already have all those numbers at your disposal. You already have a housing payment. You already know what your debts are. You know what your income is. You can crunch those numbers pretty easily. But let's just say you're looking to qualify for a new home. Maybe you're renting. Maybe you're selling your house. You want to understand, or you want to know roughly how much can I afford for that new housing payment. So that's what we're going to solve for. We're going to solve for that housing payment that you're trying to get pre-approved for. So we're going to assume that the maximum debt to income ratio is 45%. A lot of loan programs, the maximum allowable limit is 50%. Some other programs like FHA, VA, USDA, it can vary. Sometimes it can go a little above 50. Sometimes you really can't exceed 45. And it's really going to depend on your specific profile and situation. So in an effort to be a little more conservative, we're going to stick with 45%. I think it's a good, safe number to use, especially for this example. So we are going to basically kind of reverse engineer this and kind of work backwards. So starting with your income, again, it's $5,000 a month. So we are going to multiply 5,000 by the maximum allowable DTI ratio, which we just said was 45. So 5,000 multiplied by 0.45 equals $2,250. So what does that number represent? That number represents the maximum debt that you can have on a monthly basis between whatever your current debt is plus the housing payment. So the reason why we listed out here your current monthly debts, because now we'll be able to solve for what that housing payment ultimately is. So we take your maximum debt load that you can carry, which is $2,250. We just solved for that. And then we minus your current debt, which is $775. So $2,250 minus $775 equals $1,475. Now, this number is important because, as we just said, this is the maximum housing payment that you can get approved for based off of your income and your current debt. Now, again, it's important to note that this is an example, okay? It's always going to depend on your specific profile, your situation. So just use this as like an educational tool and resource when you're thinking about buying a house. You can kind of come to the game when you talk to your lender and realtor of, I already know what price range we should be in. So based off of some of the due diligence that I did up front, you're now a educated client, borrower, buyer, and you're ready to go. That $1,475, again, to reiterate, is your total housing payment. So we're talking about your principal and interest, which is associated with the loan. And then we're talking about your property taxes, your homeowner's insurance. If there's an HOA, which is a homeowners association, or condo dues, which is very common. So make sure you're factoring all those different expense items for the entire housing payment, okay? It's not just your principal and interest. It's taxes, insurance, HOA, if that is applicable. So again, hope this information was helpful. Give me a like, subscribe to the channel. If you learned anything new today, drop some comments. Let me know if you enjoyed this video. What content would you like to see next? Thanks so much again, and we'll see you on the next one.